Okay, let's take a look at chapter 3. But before we start chapter 3, let's think about let's do a short review of what we learned in chapter 1. Chapter 1, we understood the nature of accounting, the nature of business, and we looked at financial statements and we noticed how they were connected to one another. The income statement shows revenues minus expenses equals net income. The statement of retained earnings shows the starting retained earnings goes up with net income, but goes down when dividends are paid. On the balance sheet, we learned that assets, liabilities, and stockholders' equity is reported. In chapter 2, we learned about how we actually make journal entries, how we record transactions, the thinking and the analysis that we go through. We understood on page 10 the rules of accounting, debits and credits is essential for us to get a handle on accounting. We've got to memorize those, and soon they'll become secondhand easy for you. Uh, okay, so now after we recorded all the transactions in chapter 2, we ended up chapter 2 with an unadjusted trial balance. Okay, now here's a different company. Okay, it's Longhorn Tax Service, Tax Return Service Incorporated. This financial statement, this unadjusted trial balance, not a financial statement, but a trial balance, shows us account balances after a month of operations. We see in the description here that we started a new tax return business on July the 1st. Okay, so now a month has gone by. The end of July is what we're looking at now. And we've made certain transactions. In fact, we're going to see exactly which transactions for the month of July occurred and how we accounted for them and arrived at each one of these balances. And of course, the unadjusted trial balance balances. So what happens is time goes by. All the transactions are recorded, but now at the end of the month, we have some balances. But adjustments need to be made. Adjustments need to be made because, well, some things have changed. For example, we've used up some office supplies. When we recorded the office supplies in our financial records, well, that's what we purchased. But now we've used some up. A number of changes have happened. A number of things have occurred, and we need to make adjustments. They're called adjusting journal entries right there. That's what we'll be looking. These are the new. They work just like the others. They're just adjusting to adjust the account balances to bring them into agreement with reality, the actual amounts. This is complying with the revenue principle. When we earn revenues, we want to record the revenue income. Okay, we want to record that income, service revenue. Expenses, we want to record them when they are incurred, not necessarily when we pay for them, that's a separate thing, but when they're incurred. We want to make sure the assets are recorded properly, the correct amounts. For example, if we've used up office supplies, well, we'll need to bring that supplies account balance down to reality. Liabilities, the same thing. We may have more liabilities, could have less liabilities, but what's happened is some things have changed, and we want everything reported correctly. So generally accepted accounting principles, they require these. It's called the accrual basis when it happens. When revenue is earned, record it. When expenses or other liabilities are incurred, record it. Separate from whether cash can be paid later or will be paid later. Fine. What we want to do, though, is record everything when it actually occurred. On page 2, we look at the accounting period. The accounting period is always going to be at least 1 month, can be up to 12 months. It's called a fiscal year. Look at the Walmart year end. They're so busy at the end of December, they didn't want to have their year end financial statements due about the same time. So you can see they moved it. Now they go ends, 12 months ends January 31st, not December 31st. The adjustments that we're going to make fall into two categories. Prepaid expenses, where the cash payment is made before the expense is incurred. Also, we'll be looking at unearned revenues, where the customers actually pay us in advance before we do the work. There's reasons that can happen. Maybe they're going to be gone for months. Want to pay something in advance for work that we'll be doing. It happens. They're called unearned revenues. We also have a category, accruals. Accruals record the expense before the payment. Don't wait for the payment. And accrued revenue. Record the revenue before the cash is received. The customer owes us, that's fine, but we record the revenue and you'll see we'll increase accounts receivable. So bad things happen if we don't make these adjusting entries, and we'll see that on page 6. Okay, let's get this first category, the prepaids. Prepaid expenses. Recall, cash paid before the expense is incurred. The first example we've got here, we see in this paragraph, we talk about prepaid insurance. What happens is, and you'll see, here it is, our journal entry to record. A hotshot salesman comes in, sells us a package for a 12-month insurance policy on our building or on our equipment for $1,200 cash. We don't record insurance expense. Why? Because we paid for a whole year's worth. Each month needs to be hit with its fair share of that cost. So to record that on July the 1st, prepaid insurance, debit, it's an asset, increase it, $1,200, and cash goes down, $1,200. That $1,200, if you go back and look on page 1, you'll find it over there. Prepaid insurance has a $1,200 balance before we make any adjustment. Okay, but now look at this. A month has gone by. It's the end of the month now. That $1,200 is still sitting there. What do we need? What kind of adjustment do we need to make? We need to make the first adjusting. We've got 8 of them. The first one, to adjust that prepaid insurance account. What do? 1 month has gone by. That's, let's see, $1,200 divided by 12 months. That's $100 a month. 1 month has gone by. Look what we do. Credit prepaid insurance, that asset account, whittle it down. Reduce that balance down to represent 1 month's worth of insurance coverage has expired. And now that we've used that up, we have an insurance expense. Increase insurance expense, decrease prepaid insurance. The key here is you're looking and need to calculate. Sometimes it'll be given to you, $100 worth of insurance has been used up. Fine, make the $100 journal entry. Sometimes you'll get it as we see here, we bought a $1,200 policy for 12 months, and by the way, here we see 1 month has gone by, and make the adjustment for the used up or expired insurance. Similar to that, we've got prepaid rent. There's times when we might be out of town. We want to pay rent in advance, and we'll pay it in advance many times. When that happens, this example here, we're 3 months. Our monthly rent is $800 that we pay for our office space, and we pay for 3 months in advance. So on that day, 1st of July, cash goes down, credit cash, the asset account, debit prepaid rent. That is an asset account. it goes up to $2,400. Look back on page 1. Do you find it over there? Prepaid rent. There it is. And that's where it's going to sit until we make an adjustment to it. Now, again, end of the month. A month has gone by. 1 month has gone by. Our monthly rent is $800. At the end of that month, decrease that asset account prepaid rent with a credit. Debit rent expense $800 with a debit. Rent expense up, prepaid rent down. Again, same concept. Expired. We've used it up. For the next month and the next month, we'll make the same adjustment. We'll record the fact that we've had $800 worth of rent expense in each month. Office supplies. Office supplies. Okay. In a similar nature, they're an asset. When we go to OfficeMax and we buy office supplies, we record them as an asset, and we've got them. But when a month goes by, and now again it's the end of July, a month has gone by, time has gone by. Now we've been using supplies all month long, wadding up the paper, sharpening the pencils, using up all the routine office supplies. And we're going to need to adjust our books to reflect the supplies that are missing. We've used up these valuable assets, supplies, and when we use them up, they become supplies expense. So during the month, July the 9th, normal transaction, we purchased $700 worth of supplies on account. You know that means accounts payable every time. But now at the end of the month, we go in and physically count up our supplies on hand, and we only have $200. We bought $700, but we only have $200 left at the end of the month. So to record the purchase of those office supplies back on July the 9th, office supplies up, the asset account, credit accounts payable, liability account, credit increases it, office supplies up, and our debt, accounts payable, up. Okay, that's a fact. That's what happened on July the 9th. But now a month has gone by. It's the end of the month. We count up the office supplies, and we go, wait a minute. We had $700 worth of office supplies. To know what our balance in office supplies we have to go look at page 1. Again, page 1. Well, what's page 1 reflect? Let's see. Sure enough, office supplies are still there. Well, should we just leave that balance even though we've used up $500 worth of them? No. Generally accepted accounting principles said your accounting records need to reflect reality and be accurate. What do we need to do? We need to reduce office supplies. We don't have $700 anymore. Reduce office supplies by $500 and increase supplies expense. When I took accounting 1 years ago, I didn't understand the difference between, supplies versus supplies expense, office supplies. This is an expense. We've used them up. This is the asset account, office supplies. We've got fewer assets, we've used them up, and yes, we've got one more cost that month because we have used up supplies in our office. Used up is what you're looking for. Page 4, plant assets. Plant assets are all these things. They have value. They're long-term in nature. We buy them because they help us do whatever it is we're going to do for the long haul. But as we use those plant assets, we wear them out. The furniture gets worn out, the equipment, everything, automobiles, slowly but surely, we wear them out. Guess what? Accounting wants to record that, and it's an estimate. Record how much decline in value we think these assets now have. And so what we do is we use 2 accounts, depreciation expense, to get an expense on the books for our estimated decline, wear and tear, using up our valuable assets, and we keep track of how much we've taken over the time. This way, at some point, we'll know when to stop. So what happens is accumulated depreciation will grow larger and larger and larger each year. Only the first year will the two accounts, be equal to one another. This will continue to grow larger and larger. Accumulated depreciation is referred to as a contra asset account, not because it's a rebel or something, but it's because it's tucked just underneath the related asset. It's subtracted from that, and after that subtraction is that amount that's reflected is what's called the book value of the asset. Land is the only plant asset that is not depreciated because, generally speaking, land doesn't go down in value, it doesn't get used up, it doesn't vanish, it doesn't decline, wear and tear isn't a problem, so it's not depreciated. The rest of them are. So let's look at an example here. Here we've got a person, maybe someone we know up in Dallas, interested in being involved with our tax return service, doesn't have cash but has some great office equipment. We agree that it's worth $12,000, and what we'll do is we'll issue that person stock, ownership, stock, common stock, in exchange for the equipment. Now, we've got $20,000 cash that we're going to put in exchange for our stock, okay? And we think that office equipment is going to last for about 12 years. So to record, this will be ordinary entry type, chapter 2. Here we have on day 1, furniture goes up by $12,000. That furniture is turned over to the business and common stock is issued. Furniture up, common stock up. Same day, the cash that we put in, the company cash goes up, common stock goes up. We've had $32,000 increase in stockholders' equity, in particular the common stock account, and we've had $12,000 asset added and another $20,000 asset added to the business. So here we have, it's our adjusting journal entry number 4. In this chapter, I'm showing you the calculation. In future chapters, we'll have to calculate it ourselves. But right now, it's just given to us. And so we don't have to look anywhere. We just go with the $83. And the estimate is that equipment, that furniture, it's not equipment, it's furniture, is being used up, declining in value about $83 a month. Here's the 4th adjusting journal entry. Depreciation expense, record our estimate of the decline in value, $83, and accumulated depreciation, that contra asset account, goes up. Expense up and accumulated depreciation, furniture up. Okay, now let's go to this next category. Unearned revenues. Unearned revenues. The cash is received before the revenue is earned. I do tax returns every year. If a lady comes in and says, please do my tax return, I say, yes, I'll be happy to. It's $300 today. Let's say it's January of that year, January. But I say, ma'am, I'm not going to do your tax return until April 15th. She says, fine. Pays me, what did I say, $200. That day, I deposit the cash. But I'm not going to do the work till April the 15th. If she comes back tomorrow and says, listen, I found somebody to do my tax return for $50. Give me my money back. Would I have to give her a refund? Well, I would. And you know why? Because I have not earned it. Once I've earned it, sorry, ma'am, here's your tax return. I've completed it. You're not due a refund. That's an example. Unearned revenue. Get the money before we earned it. So in our company here, let's look at this. Okay, look at this. We just completed a big complex corporate tax return. The customer picked up the return and paid $9,000 for that complicated tax return. Here's how we would record that. It was July the 20th, cash up by $9,000, service revenue up by $9,000. We earned it and we got paid cash. Okay. Now as we're walking out, turns out some people stop us in the parking lot and say, listen, we'd like you to do some tax work for us. And we say, fine, pay us now $300 for these 3 tax returns, but we're not going to do them right now. We're going to do them later. Okay? And so what we find, look at this, on the day we collect that cash in advance, yes, cash is going up, but we have not earned it yet. It's unearned revenue. It's that liability account. That $300, as the note says, confirm, is it on page 1? It sure is. $300 is still showing that we owe someone. But the fact is, look what happened. 2 of them during the month, we completed 2 of those tax returns. So we ask ourselves at the end of the month, do we need to make an adjustment? We do, to record those 2 that we completed. What do? Look at this. Debit that liability account, unearned revenue, to decrease it. We don't owe people $300 any longer. We've earned $200 of that. And yes, service revenue up. We've earned $200. We owe them. We do not owe that $200 to them any longer. If we fail to make these adjustments here, well, our balances would still show us owing $300, and that would be incorrect. Okay, let's move on then. That was number 5. Let's move on now for accruals. There's 3 more that we're going to look at. Accrued expenses before the cash payment. Salaries, for example. Salaries are paid after employees earn them. In our example here, for the month of July, we've had 2 paydays. Okay, we had a payday in July the 8th and July the 22nd. And each payday, we paid the employees $2,000. Okay, and now it's at the end of the month. Remember, it's at the end of the month. We're going, well, do we need to make any adjustments? Well, we look at the pay and we find that there were 7 work days near the end of the month where the employees had not been paid. That salary expense has not been recorded yet. That liability, the amount that we owe the employees, has not been recorded yet. Here's the 2 routine entries for the 2 payments we made during the year. If you look over to page 1, there it is, $4,000 salary expense that's been recorded. Now it's the end of the month. Remember, and those 7 days, $200 a day we owe the employees, that $1,400, okay, that we need to accrue that expense. We need to reflect that fact in our financial accounts. So what do? Salary expense up. Salaries payable up. We've got more expense for the month. Those employees work those days, and at the end of the month, we owe the employees $1,400 for work that they've done where they haven't been paid. What they're owed is the adjustment we have to make. Other accrued expenses, things like utilities, advertising, similar expenses. Okay, these invoices come in, all the time. Many times during the month, and we'll get a bill near the end of the month. In this case, it's advertising. Maybe we're doing online advertising with Google. We had tax return service and we agreed to pay them, 2 cents for every hit, every time somebody saw our ad that month. And so then they gen a bill for $400. Okay, but it came in late in the month. Well, at the end of the month, we don't have any advertising expense for the month on page 1 at all in our unadjusted trial balance. But yet, you know what? We've had an advertising expense. It just has not been recorded yet. At the end of the month, journal entry, adjusting journal entry 7, what do? Get that advertising expense increase by 400, increase accounts payable with the credit. Liability account goes up. Advertising expense up, accounts payable up. The last one, and there are others, but these are the key 8 that we're going to be looking at. Accrued revenue, when we've earned some money, but we haven't been paid yet. Happens all the time. We do some work, we're having a year end of the month meeting. We ask anybody finish a tax return, but we haven't billed the customer yet. Somebody raises their hand and says, yes, our team's been working on a $500 return and we've completed it, but we have not billed the customer. If that's the case, that means it hasn't been recorded yet. Those employees, we made sure all of their salary expense got in there when we adjusted the salary expense. Now let's make sure that in that month that we get the revenue from the work that they've completed recorded in that month. What have we got? Accounts receivable, the asset account, up. Someone owes us $500, and yes, service revenue. We have earned another $500 of work. For the work that we've done that month, we've owed another $500, and we have an additional service revenue of $500. So if we look at the bottom of page 6, what happens? If we were to go through and base our financial statements on an unadjusted trial balance, we'd have all kinds of problems. Now, here's a summary of the problems. If we forget to record some of these prepaid expenses like prepaid insurance, prepaid rent, that sort of thing, if we forget to make those, well, rent expense is not going to be as high as it should. Insurance expense is not going to be as high as it should because that 1 month of use isn't going to be recorded. If we fail to adjust a supplies account, well, we're not going to have all the supplies expense that we should have. Here's the impact on that. For example, supplies, we'd be showing supplies, hey, we've got $700. Well, when we really don't, we've only got $200. Take a look at each of those. Okay. On to page 7, we look at a T account. We know about T accounts, okay, from chapter 2. Here's the postings. There's the journal entries we made that we looked at in this chapter. Here's the unadjusted trial balance. Make sure that's what's on page 1. That's the unadjusted balance. I notice here, if you look at the key at the bottom of this table, unadjusted balance and the adjusted balance. Well, they're the same. We didn't touch the cash account in this chapter. We didn't make any one of our 8 adjustments to it. But now each and every one of our adjusting entries we post over here and reflect it on these T accounts. Let's see, what was the first one? It was the prepaid insurance. What did we, let's see, here it is, insurance expense. We post that we debited, look at adjusting journal entry, we debited rent expense $100, okay, and we credited, let's see, where's prepaid rent? Prepaid insurance. Here it is, prepaid insurance. That's what we did. We credited prepaid insurance and we debited insurance expense. Now we reflect them on the T accounts. Look at this. Okay. What's the key say? Oh, adjusted trial balance. The new balance. The balance is going to show up on our financial statements. Now, correctly, we only have $1,100 of prepaid insurance at the end of the month. And yes, we now have correctly recorded $100 worth of insurance expense. Okay, I think you see how that works. Well, let's look at the second one. The second one, what did we do? We adjusted prepaid rent. Okay, I see right here. Here's the credit to prepaid rent. Prepaid rent, $800. After the end of the month, by the end of the month, at July the 31st, how much do we have paid in advance? Only $1,600. And let's see. Let's go down. Where's our rent expense? Rent expense. There it is. We post the rent expense and change the account balance. We do that for each and every one of those entries that we made. Okay, now check this. Those T account balances better agree because this is the adjusted trial balance. Oh, look, there's the, yes, okay. Accounts receivable, remember we increased it for that work that we'd done, but we weren't paid. Prepaid insurance, 11 months worth is really what we had. Prepaid rent, down to the $1,600. Hey, there's the office supplies. That's what we counted up on hand. So we have adjusted these balances to reflect reality. Okay, and here's a short summary just to check your understanding about what we've done. There's nothing special about E, except that I just couldn't get it into that box right there. E. So each one of these, take a few minutes and go down and take a look at what we did in this chapter. These balances right here, when we do financial statements, and you'll see it coming, these are the balances that we'll use to do our financial statements. Okay.